What if I told you a single name, one potential pick for the next Fed chair, was enough to make people thousands of miles away rush into physical silver like they don't might trust paper promises anymore? Not buy a little more. I mean the kind of move traders describe as a bank run, where the question stops being, what's the price, and turns into, can I actually get it? And the wild part is, the loudest signal didn't come from Wall Street. It showed up in Asia, where the Shanghai market suddenly started flashing a premium that people kept pointing at. Around $131. Not a normal day, not a normal spread, a stress signal. Now, before we go any further, I'm not here to scare you, and this is not financial advice. This is a story about incentives, trust, and what happens when the world starts gaming out a future where the Fed-S direction could flip fast. Because when you change the person steering the world's most important central bank, you're not just changing interest rates. You're changing the rules of the whole confidence game. And if you like these kinds of clear, no-hype breakdowns that connect politics, markets, and real-world money, take 1 second right now, hit the like button and subscribe. It helps the channel a lot, and it tells me you want more of this. So let's set the scene. The headlines started swirling that Trump's team is looking at Fed chair candidates again. Maybe it's a short list, maybe it's trial balloons, maybe it's a message being sent to markets. But traders don't wait for a signed letter. They trade the expectation. And the moment those names hit the conversation, the market immediately started asking one question. What kind of Fed are we about to get? Because there are two very different futures here. In one future, the Fed stays more independent and keeps rates higher for longer if inflation stays sticky. In the other future, the Fed gets more political pressure, more urgency to cut, and more tolerance for printing and debt support when things crack. And when that second future starts to feel more likely, the dollar story changes. Bond yields can whip around, and real assets, especially precious metals, start to act different. That's where silver steps in. Silver isn't just a metal, it's a weird hybrid. It's money in people's minds when trust drops, but it's also an industrial material when factories are booming. So when silver starts moving fast, it's usually because something bigger is going on underneath the surface. And what people started pointing to was this. Physical buying pressure in Asia, especially signals tied to Shanghai, looked like it was getting intense. Premiums jumped, availability got tighter. The vibe was, get the real thing while you can. Now, let's talk about that $131 number without getting sloppy. Different reports and data feeds track different products, bars, kilos, contracts, delivery premiums, local taxes, and spreads. But the point isn't the exact math down to the penny. The point is the message. Shanghai was showing a physical market willing to pay up, meaning real demand was leaning hard against real supply. That's the opposite of a calm market. And here's the twist that makes this story so important for the next 20 minutes. This isn't just about silver bugs getting excited. This lines up with a much bigger pressure point in the U.S. financial system, what some analysts call a $1.7 trillion problem. And if you're thinking, wait, 1.7T of what? Good. Keep that question, because we're going there. But first, you need to understand why a Fed chair pick can ripple all the way into physical metal flows in Shanghai. Think of the Fed chair like the pilot of the global dollar system. When the pilot changes, everyone on the plane starts watching the seatbelt sign. You might be sitting in New York, but the turbulence hits Tokyo, London, and Shanghai too. Because the dollar isn't just America's currency, it's the world's pricing unit for debt, energy, trade, and liquidity. So when markets start pricing in different pilot, different flight path, you get sudden repositioning. Some of it is calm and mathematical, but some of it is emotional. I don't want to be the last person holding paper if the rules change. And that's how you get a bank run vibe in a metal. A normal buyer says, I'll buy if the price dips. A stressed buyer says, I am buying now because I'm not sure I'll be there later. So the big question for you is, are we watching the early stages of a confidence shift, or is this just a short-term panic move that burns out? Let's start with the Fed chair effect, because people underestimate how psychological it is. Yes, the Fed chair doesn't set prices for silver directly, but the Fed chair shapes the environment that decides whether holding cash feels safe, whether holding bonds feels safe, and whether holding real stuff feels safer than holding promises. And silver lives right in that crossroads. Here's the simplest way to think about it. When interest rates are high, cash and treasuries look attractive. You can earn yield just sitting there. That usually puts pressure on metals because metals don't pay interest. But when the market believes rates are about to fall hard, or that the Fed might tolerate more inflation to avoid a crisis, then suddenly holding dollars feels less rewarding, and metals can catch a powerful bid. Now add politics. If markets believe the next Fed chair would be more willing to cut rates aggressively or more willing to support the Treasury market if it gets shaky, the market can start front-running that. And front-running means moving early, sometimes violently. So why would that hit silver so hard? Because silver has two extra features that make it prone to these rush moments. First, silver is smaller than gold in market depth. It doesn't take as much money to move it, especially in physical form. Second, a lot of silver trading is paper-based. Futures, swaps, unallocated accounts, where many claims can exist on the same underlying metal. That structure works fine when everyone is relaxed. But when the mood shifts, people start asking a dangerous question. If I want delivery, can I get it? That's where the bank run comparison comes from. In a fractional reserve bank, not everyone can withdraw cash at the same time. In a heavily paper-claimed commodity, not everyone can demand physical at the same time without stress showing up somewhere. Premiums, delays, inventory drawdowns, or spreads between regions. And Shanghai is important because it's a window into physical behavior. When Shanghai prices diverge sharply from Western benchmarks, it can signal physical tightness, local demand surging, or barriers like shipping and refining constraints. But again, don't get stuck on one number like it's magic. Watch the behavior. Premiums rising means people are paying extra to get metal in hand. Now let's connect this to the Fed chair story in a way that actually makes sense. Imagine you're a large buyer in Asia. You've watched the US run big deficits. You've watched debt loads climb. You've watched inflation spike and then cool but not disappear. And you've watched the US banking system take hits when rates rose too fast. You might be asking, what happens if the next Fed changes the pace? What happens if they cut fast? What happens if they quietly restart money creation through the back door? If you think that risk is rising, buying physical metal is a rational hedge. Not because you think the world ends tomorrow, but because you're managing uncertainty. And silver is a hedge with a twist because it's also tied to real manufacturing demand, solar panels, electronics, EV components, industrial coatings. So if you believe the US could push for easier money while the world still needs metal for industry, you can talk yourself into silver pretty quickly. Now here's where the story gets more intense. When these shifts happen, the first thing that moves is usually paper price. Futures jump, algos react, headlines spread. But then something else starts. People try to convert paper excitement into physical ownership. And the physical market can't expand instantly. Mines can't double output next week. Refineries can't teleport product across oceans. Inventories can only cover so much before premiums rise. So when you hear silver bank run, don't picture chaos in the streets. Picture something quieter, but just as revealing. Wholesalers quoting wider spreads, delivery times stretching, and buyers saying, lock it in, I'll pay extra, just allocate it. And you should ask yourself something right now. If everything is fine, why would anyone pay a big premium for physical silver in one of the most important commodity hubs on Earth? Sometimes it's a short-term logistics issue, sometimes it's local policy, but sometimes it's a trust signal. Now, let's talk about the names and why markets care, without pretending we know the future. A Fed chair candidate can represent a style. Some represent strict inflation fighting, even if it hurts. Some represent easier money sooner, especially if unemployment rises or markets wobble. Some are more open to unconventional tools, balance sheet expansion, yield support, regulatory easing, and other moves that can quietly add liquidity. If traders hear a potential pick and interpret it as dovish, meaning more tolerant of lower rates and more willing to support markets, they often respond the same way at first. Risk assets up, yields down, dollar softer. Metals can rise because the opportunity cost of holding them drops, and the currency confidence question grows. But here's a detail most people miss. Silver can behave like a coiled spring in these moments because a lot of silver supply is already spoken for by industrial demand, and the investable portion is smaller than people assume. So if even a small slice of global capital decides, I want physical, the physical market feels it immediately. And if you've watched markets long enough, you know this pattern. First, the paper price moves, then the physical market starts shouting through premiums, and then the headlines catch up. So if the Shanghai premium really jumped toward triple digits in the way people were sharing, again, depending on the unit and product, that's not just silver is up today. That's physical silver is being treated like something you secure, not something you trade. Now let me bring in the other half of the title, the $1.7 trillion crisis, because this is the fuel under the fear. And when you see silver behaving like a stress asset, it is often because people smell instability in the plumbing of the financial system, not just inflation in the grocery aisle. So what is this 1.7T problem, and why does a Fed chair pick connect to it? Let ES talk about that 1.7 trillion number in a way that doesn't T waste your time. One of the biggest quiet threats that showed up when rates surged was unrealized losses in the banking system. Banks hold piles of bonds and long-duration securities. When rates rise, the market value of those older low-yield bonds falls. If the bank has to sell them to meet withdrawals, those unrealized losses become very real. At different points over the last couple of years, estimates for unrealized losses across the system have floated around huge numbers, and the headline figure people keep repeating is roughly 1.7 trillion. The exact number changes with yields and reporting periods, but the concept is stable. higher rates created a giant hole in the mark-to-market value of bank assets. Now pause and think about how this ties to the Fed chair. If markets believe the next Fed leadership would cut rates aggressively, that could actually help those unrealized losses shrink because bond prices rise when rates fall. Sounds good, right? But it comes with a catch. Cutting rates aggressively is often a response to something breaking: growth slowing, credit tightening, banks under stress, or the treasury market getting unstable. So the market has to decide which story is dominant. Cuts are coming because everything is fine and inflation is solved. Or cuts are coming because something is cracking and the Fed has to choose between pain now or bigger pain later. When people lean toward the second story, you often see a strange mix. Some assets rally on the promise of easier money, while safe haven behavior starts building under the surface. That's where gold and silver can both catch a bid, but silver can go wilder because it's thinner and more emotionally traded. And now layer on top the other stress point nobody can ignore: U.S. debt and refinancing. The U.S. has to roll over a mountain of treasuries regularly. When rates are high, the interest burden climbs. That doesn't instantly crash the system, but it tightens the budget and narrows policy choices. This is where the Fed chair matters again, because the Fed is the backstop of the treasury market, even when it claims it isn't. When liquidity disappears, the Fed is the only actor big enough to restore it quickly. So if traders think the next Fed leadership will be more willing to step in, directly or indirectly, you can get a front run into hard assets. Not because everyone expects hyperinflation tomorrow, but because the long-run credibility of sound money feels shakier. Now add one more layer that makes this feel like a thriller: commercial real estate and regional banks. A lot of commercial real estate debt has to refinance over the next few years. Higher rates and lower office demand are a bad mix. If refinancing gets ugly, regional banks, already sitting on those bond losses, can get hit again through credit losses. You don't need a full banking collapse for confidence to wobble. You just need enough weak links that depositors and investors start asking, who's next? And when that question gets loud, people don't just buy stocks or bonds. They buy what they can hold outside the system. That's when bank run language shows up around metals. It's not always literal, it's behavioral. It's a rush from promises to possession. So here's the big takeaway, and I want you to really think about this like a strategist, not like a gambler. The Fed chair conversation matters because it changes expectations. Expectations change positioning. Positioning changes flows, and flows are what move prices and premiums. If the market believes the next Fed chair will be more politically pressured, more willing to cut, or more willing to support markets during stress, the dollar can weaken at the margin. Real yields can drop, and metals can get bid. If at the same time the physical market is already tight because of industrial demand and inventory realities, premiums can spike and you get those Shanghai-style signals that everyone starts sharing. Now, what should you watch next if you want to know whether this story continues or fizzles? Watch Treasury yields, especially the 10-year. If yields drop fast, while inflation expectations don't drop as much, that's supportive for metals. Watch the dollar index. A weaker dollar can amplify silver moves. Watch credit spreads. If spreads widen, that's stress. Watch bank headlines, but more importantly, watch deposit behavior and funding markets. Repo stress, sudden liquidity programs, emergency language. And if you can find reliable data, watch reported inventory trends and physical premiums across regions. Because premiums tell you what paper prices can, or T, whether people are actually grabbing the real thing. Also watch the narrative from the Fed itself. If the tone shifts from fight inflation to protect growth too quickly, markets will assume the Fed sees something you don't. And that is when hedging behavior accelerates. Now let me ask you a direct question, because I want you involved in this, not just listening. Do you think the next big market problem is going to look like 2008 credit collapse? Or is it going to look like a slow grind where debt and deficits force policy to get looser over time? Because your answer to that question changes how you interpret moves in silver. A fast crash creates one kind of rush. A long erosion of purchasing power creates another. Either way, this is why silver keeps popping up in these moments. It sits at the intersection of fear and function. It's a monetary metal in people's minds, and it's a critical industrial input in the real economy. When confidence wobbles and supply isn't infinite, silver can go from boring commodity to everyone is talking about it very fast. And that brings us back to the headline. Trump S-Fed chair pick, whether it's a real decision, a leaked shortlist, or strategic messaging, can act like a match near dry grass because it forces the world to reprice what the Fed will do when the next stress wave hits. And if people believe the answer is print, cut, and support, then physical metal demand doesn't wait for confirmation. Now I want to hear your take. Do you think this Shanghai premium action is a real warning sign, or do you think it's just temporary dislocation and social media hype? Drop your opinion in the comments and be specific. What signal would convince you either way? And if you know someone who has been ignoring the risk side of the economy because the stock market looks fine, share this video with them. Not to scare them, just to make sure they're watching the right indicators. Because in markets, the biggest losses usually happen when people stop paying attention right before the story trends.